Sometime around mid-April, millions of Americans file their taxes, pay what they owe, and breathe a sigh of relief. The deadlines are met, the math is done, and the tax year is officially closed. But that sense of completion really only applies to standard W-2 earners. If you run a small business, April 15th is often a false finish line. Let's say your business generates profit, and you invest those funds into physical assets. You buy heavy machinery to stamp parts, desks for an office, or computers for your staff, and you claim those purchases as a federal business expense to lower your income tax. That is exactly when local municipalities step in. Many cities and counties levy a business personal property tax, or BPP. This annual tax specifically targets the exact physical items you use to run your company. This creates a recurring obligation. While the federal government allows for a one-time deduction based on the purchase price, the local municipality views the asset as a persistent source of revenue, taxing it annually as long as it remains on your books. To see exactly how local governments track and enforce this, look at this document. This is the 2025 Business Personal Property Tax Return for Franklin County, Virginia. It provides a specific snapshot of how these local tax mechanisms operate. The instructions establish a rigid timeline. Own tangible property on January 1st, you owe the tax. Property cannot be prorated. Sell equipment on January 2nd, you still owe for the full year. Finally, missing the May 1st deadline triggers an immediate 10% penalty. Local jurisdictions don't care if your business is struggling in July or if the asset broke down in October. They use these date-based snapshots to lock in municipal revenue based on exactly what you owned on New Year's Day. Local governments don't let you estimate asset value. Under Schedule 1, they require a detailed list of every property's purchase year and original cost. Panning down to Schedule 2 reveals a separate section isolating heavy machinery to apply different tax rates. The instructions also contain a specific filing requirement. Business owners must attach a complete copy of their most recent federal income tax return, specifically including the depreciation worksheet. This bridges the gap between federal and local. When your accountant depreciates an asset to lower your federal tax bill, that list of equipment goes straight to the local tax commissioner. The county uses your federal depreciation list as an exact checklist. The documentation submitted to lower your federal tax bill becomes the primary tool the local government uses to ensure you are paying the full amount of local property tax. While we're looking at Franklin County's specific paperwork, the underlying mechanism is nearly universal. Across the country, local jurisdictions use this exact same framework to tax the physical footprint of small businesses. The exact rules vary depending on where your business operates. Some counties require you to report anything valued over $25. Others have no minimum limit at all, or demand that you separate out computer equipment onto entirely different schedules so they can tax it at a separate rate. Running a compliant business requires a shift in how you evaluate equipment purchases. When you buy a server or a delivery van, you have to look past the immediate federal income tax write-off and calculate the long-term local cost of holding that asset. This means actively managing your inventory. You have to register your business locally, maintain records of acquisition dates and original costs, and ensure that your local BPP filings perfectly match the depreciation data you send to the IRS. Ultimately, making a business purchase is a long-term municipal commitment. For millions of small business owners, the tax year is never truly over until the local property tax is settled.